Hi, this is John Edson. I'm a principal with Smith Schaefer and Associates, and I lead our business valuation department. And today we're going to talk about what my business is worth, and we're going to split this into two parts. And the first part is going to be about business valuation background, and then the second part will be business valuation methods. For business owners, their most valuable asset is typically the business itself. And one of the ultimate goals is, how do you turn your business into your pot of gold? And we want to make sure that we have financial security. So we want to maximize our value and convert the business to cash ultimately in some form. And business valuation plays an important role in helping you plan for that. So we do this through planning. And valuation is the basis of this planning. So we have options where we can do estate planning, or we can do succession planning, or we can do it for insurance purposes to insure against a catastrophe that may be unplanned. The planning opportunities that we have include having a buy-sell agreement. All business owners should have a buy-sell agreement in place so that if something unforeseen happens, there's a smooth transition of the business. There's gifting to family. So that's another way of transitioning the business to other owners and assuring the continuity of the business. And then there's selling to third parties, of course, where you convert your business value, which may be on paper, into cash or other investments, and thereby realizing your pot of gold. And we could do that with a financial buyer or with a strategic buyer, and we'll talk about that in a little bit. There's always the option to sell to employees and realize your pot of gold that way. And then there's also, and that could be a straight sale, where they're the owners, or we could do an employee stock ownership plan, which is like a retirement plan. And in that case, the retirement plan owns the stock in the company. And then the employees are participants in that plan. And finally, there's deferred compensation plans that could be put in place for the owner and that would supplement retirement accounts and would supplement other transition transactions, supplement other transition transactions so that we maximize money, cash payments to the owner. The value of a business is the value of the benefits that the investor will receive. It's just like buying a share of stock on the New York Stock Exchange. You're either looking for increase in value or you're looking for dividends. In the case of a private business, we're looking for cash flow, typically, first to pay for the business, and second to give the investor a return on investment. So here's a simple example. If a business generates cash flow to the owner of $200,000, the buyer desires a 20% rate of return on the investment, the buyer would be willing to pay $1 million for that. And the math behind that is $200,000 divided by 20%, and that gets you $1 million. So the driver of value, if you take the combination of this, the driver of the value is EBITDA, which is a surrogate for cash flow, but that's earnings before interest, taxes, depreciation, and amortization. And that, as I say, that equals cash flow. Types of buyers. Let's talk a little bit about that, because certain buyers may be willing to pay more for your business than other buyers. So we have a financial buyer, And that is a person who is an individual investor or a small group of investors. And they do not own a business like yours. And so they're going to operate your business in the same manner that you operate it. And that's called, as I say, a financial buyer. And then we have strategic or synergistic buyers. And those are the type of buyer that already is in your industry. So for instance, it might be somebody, if you own a manufacturing company, they may already be in a similar type of manufacturing company, and they're going to blend their business into your they're going to blend your business into their business. And therefore, there may be some cost savings. They may already have an accounting staff. They may have engineering department. They may have other cost savings that they get. And therefore, the earnings from your business may increase because of the synergies of the two businesses combined. Therefore, a synergistic or strategic buyer may be more willing to pay more for your business than a financial buyer. So let's talk about investor expectation. As I mentioned earlier, the multiple of earnings is based on the rate of return that an investor desires. So the greater the risk, the greater the return expected. If you have a company that is a home builder and is subject to the fluctuations of the economy and interest rates and so on, the value of that business may be less because the risk is greater than another business that has more stable and is more stable and is not subject to the risks of the economy and so on, and interest rate risks. So therefore, we always want to consider when we're doing a valuation the risk return that the investor is going to expect. So here's a graph that shows how that works. So as I said, the greater the risk, the buyer demands a greater return. And so then if the buyer's demanding a greater return, then the value will go down. And so you can see that this line here is value and this line here is risk. And the value goes, as the curve goes, if we have a lower risk percent, risk of return, then we have a greater value. If we have a higher return demanded, then we have a lower value. So this concludes the first part of our presentation on what's my business worth.